Let's take a look at problem 1412 dealing with warrants. I'll read the problem to you. Davis Company issued 11,250 of its $1,000 par value bonds for $1,310, providing total cash proceeds of $14,737,500. Davis did not incur any bond issue costs, and the bond interest is paid annually. The market price of the common shares on the date that the bonds were issued was $125 per share. The bonds were sold with 22,000 warrants to acquire 22,000 shares of the company's $1 par value common stock for $125 per share. Davis has existing bonds outstanding that trade with warrants at 1,200. There are other Davis warrants outstanding that trade for $87.50 each. The market value of the company's bonds is considered more reliable than the trading price of the warrants. All right, we've got a number of requirements here. So let's tackle requirement A first, which asks us to prepare the journal entry to record issuance of the bonds, assuming that the warrants are not detachable or non-detachable. Okay, so if under this set of circumstances, what we're going to do is record a premium on the bonds payable equal to the 1,310 price, that's given right here, minus the par value times the 11,250 bonds. So that's the premium. Now the par value of the bonds would be the 11,250 bonds times $1,000. Okay, that gives us $1,250,000, and the total cash proceeds is $14,737.5, which they gave us. Okay, next let's take a look at requirement B that you see right here. It says prepare the journal entry to record the issuance of the bonds, assuming that the warrants are detachable using the proportional method. So let's take a look at that solution next. Okay, so in this instance, we've got the 11,250 bonds with a fair value of $1,200. And that gives us 13,500 when we do the multiplication. Now, if you're wondering where the 1,200 came from, it's right here. They had existing bonds outstanding that trade without warrants, so we have a value for the bonds. And then we issued these with 22,000 shares, and they have outstanding warrants that trade for $87.50. So we've got a fair value that we can use there. And we multiply across, and we can figure out the percentage of the total, right? And then we can take the cash proceeds and do the proper allocation. So if I slide down, we can then see our entry. We would get $14,737.500 in cash. The premium on the bonds payable would be $1645,312, with additional paid-in capital on the warrants equal to the $1842. Now, how did we come up with these amounts? Well, the par value we already know is calculated the old way, right? The way we saw in part A, 11,250 times 1,000. And we have a allocated amount that justifies the warranty price. There's our 1,842. So we essentially force the premium on the bonds payable. Okay, so let's look at requirement C. Now, requirement C right here says to prepare the journal entry to record the issuance of the bonds, assuming that the warrants are detachable using the incremental method. So let's take a look at this solution now. Okay, so let's take a look. The total proceeds are the same as what we've seen before, $14,737,000. But now we need to subtract out the fair value of the bonds, which is $13.5 million. How do we come up with that? Well, the number of bonds times the price per bond that's currently trading gives us $13.5. Okay, So 11,250 times 1,200 gives us 13,500,000. That gives us the residual that we could allocate to warrants. Okay, so now what we know is we can compare the bonds payable at par value compared to the fair value, and we know that the premium is 2250. So we drop in the various amounts, and you can see the entry down here below. Okay, so let's look at requirement D now. Now, requirement D says, assuming that the proportional method is used, prepare the journal entry required to record the exercise of all the warrants. So let's take a look at that solution. And I'm starting off by providing the solution to part B, so we have the information that we calculated before. Okay, so if I can just get this to show up in the right amount, we can see. All right, so here's the part B solution with the entry. So now to exercise the warrants, well, what do we have to do? Well, we had additional paid-in capital of $1,842,188 recorded in addition as additional paid-in capital for stock warrants. And now what we are doing is we're preparing the journal entry to record the exercise of the warrants. So when we exercise those warrants, the additional paid-in capital will go away. Therefore, we'll debit additional paid-in capital. All right, we'll collect cash, 22,000 times 125. Okay, and so then the additional paid-in capital in excess of par is essentially the amount forced after we record the par value of the warrants, 22,000 at $1 each. Okay, and right there we see there's the par value for the of the warrants. All right, so once we record those entries, we essentially are forcing the amount that goes to additional paid-in capital in excess of par. Okay, and now we get to the last part of this question, part E. I'll read it to you right here. It says, assuming that the incremental method is used, prepare the journal entry required to record the exercise of the warrants. So let's take a look at those solutions. Now, here's part C, what you showing the incremental method. So we have that information in front of us. And then here we can look at the solution. So now what we're doing again is debiting the cash, the 22,000 at 125 each, right? The common stock gets recorded at the par value, but the additional paid-in capital that we previously had allocated to the stock warrants was $1,237,500. So we eliminate that, and then of course we force the difference to additional paid-in capital, and that becomes that value you see right there. So that's this problem. I hope you found this helpful.